Want to know how small business loans work? What are your options? In this video, I will be discussing the most common loan types for your small business, so keep watching. There are many types of small business loans to choose from. The way they work depends on which loan you choose. Here are the most common loan types available to small business owners: term loans, lines of credit, SBA loans, equipment loans, invoice factoring, and merchant cash advances. Term loans are a traditional loan where you borrow a lump sum up front and pay it back with interest within a specified schedule. Long-term loans offer you repayment terms longer than 5 years, while short-term loans are usually a year or less. Short-term loans offer the most flexible qualifications and are the fastest to fund. However, can be a more expensive type of loan. Long-term loans require top borrower qualifications and are slower to fund, but also offer the lowest interest rates. There's also intermediate term loans, which have a repayment period of 1 to 5 years. What's great about term loans is that you can use them for a variety of purposes, such as working capital, purchasing equipment or inventory, and business expansion. When applying for a business term loan, you should expect to provide bank statements, financial statements, personal and business credit scores, as well as proof of collateral in some cases. The next type of loan we'll discuss is a business line of credit. It is a source of funds that can be used whenever you need to, just like a credit card. Interest is paid only on the money withdrawn. Once repaid, the credit limit is available again to be accessed as needed. Lines of credit can be secured by collateral or may be unsecured depending on the size of the line requested. Interest rates vary, but you can use the funds for anything as long as it's a business expense. Applying for a line of credit is much like a term loan. Lenders will want to see documents that demonstrate a good track record and creditworthiness. An SBA loan is a small business loan which is partly guaranteed by the Small Business Administration. These have extremely flexible rates and terms, but do have stricter lending requirements and standards. The drawback to these loans is the extensive application process, which can take months to be approved. There are multiple types of SBA loans, each with their own terms and conditions. Some of the SBA loans include 7A loans, 504 loans, microloans, and express loans. SBA 7A loans are the most commonly sought after since they give you access to up to $5 million and a repayment term of 25 years. They can be used for working capital, expansion, and equipment purchases. SBA 504 loans are more specific as they can only be used for the purchase of long-term fixed assets like land and machinery. Equipment loans are another type of business financing you can get, which you can use to buy business equipment. The best part about this type of loan is that you don't need perfect credit or a great financial history to obtain one. This is because the equipment itself is usually used as collateral in case you default. The loan lasts as long as the equipment itself does, so it's also not a quick payoff. To obtain an equipment loan, you'll need to bring a quote to your lender, showing them how much the item you want to buy will cost. Generally, loans are granted on equipment that won't rapidly depreciate in value. Next up is invoice factoring. Technically, invoice factoring is not a loan. You sell your invoices at a discount to a factoring company in exchange for a lump sum of cash. The factoring company then owns the invoices and gets paid when it collects from your customers, typically in 30 to 90 days. Invoice factoring is usually for a business that needs fast funding, has reliable customers that pay on time, and can afford the fees. The discount rate, also known as the factoring fee, can run from 1 to 5%. This number depends on the invoice amount, your sales volume, your customer's creditworthiness, and whether the factor is recourse or non-recourse. Lastly, let's discuss merchant cash advances. A merchant cash advance is a cash advance that you pay back with a percentage of your daily sales. You're essentially selling your future sales at a discount. Instead of making one fixed payment every month over a set repayment period, you make daily or weekly payments plus fees until the advance is paid in full. This is one of the most expensive options in this list. However, qualifying for an MCA is easy. You don't need to have years in business to qualify or excellent credit to be approved. As long as you have solid sales numbers, at First Union you can apply for most of these loans and more. First Union Lending offers numerous financing programs designed with small businesses in mind. Our business loans are fast and flexible, with financing options ranging from $5,000 to $2 million. Call today to learn more about our various financing solutions to help your business grow and become successful.